So good morning, everyone. Thank you for joining us today to this week's Tavistock Wealth Market Update call. My name is Connor Stewart. Please, throughout this call, can everyone make sure their microphones and their cameras are switched off? This call, as we know, is being recorded, and it makes it a lot easier for our team to cut the video up for you all after. If you have any questions throughout this call today, please use the chat function. We'll put the questions in there for you and we'll ask them at the end. There will be a section at the end where we can do a Q&A with John. John, are you set up? Are you all on? Can you hear me?
Hey Connor, can you hear me?
I can, John. How are you? Are you well?
Yeah. Doing well. Can't believe it's almost Christmas. How about you?
I know. It's gone very quickly this year. Not a year that maybe we'd want to remember, but it's gone extremely fast, which I guess is the only positive thing. But yeah, I'm all well. So yeah, without further ado, I'll let you crack on, John.
Okay, thank you very much. Just to start, a big thank you to everyone who donated to the investment team's Movember cause. Very happy to confirm that we grew 6 rather dubious moustaches. We ran 280 kilometers during the month of November, and so far we've raised £1,141. So really proud of the team. Big thank you to all of you. I will ask Connor to, for the last time, just put the link down to the to our Movember page. We're called Tavi Momos. So by all means, log on, take a look, and if you haven't already, please feel free to top up our total. Moving on, today joining me on the call, we have Andrew Potty, who runs our fixed income exposure, and Sirka Injan, who runs our equity exposure. So same format as usual, just going to go through some high-level macro slides, give you our views of the market, and then Sirka and Andrew will each go into each of their respective areas as well. But first and most important, performance. So if we just move on to the first slide here, this is the performance of the Acumen portfolios over the last 6 months up until the 30th of November. It's just before I go over the full six-month performance, I think it's worth noting that November was utterly remarkable in that it was probably, well, it is the best market return on record, particularly for certain indices. In terms of the Acumen portfolios for November, the top end of the range returned between 6 and 7% in the month, and the bottom of the range, AP3, predominantly bonds, was just shy of 2%. And the income portfolio, the laggard, which is more tilted to value exposure, returned in excess of 7%. So, you know, truly remarkable performance over this period. These numbers are for the rolling 6 months, so from the end of May to the end of November. As you can see, we continue to perform well, outperforming the market composite benchmark, but more appropriately, perhaps to many of you, outperforming the peer groups. So you can see I've put on the IA sector there, and also the ARC performance numbers, which many of you also use. And you can see we've done very well against all of those, particularly ARC. And going back to the IA sector, you know, over this period, very strong performance. Once again, we're in the first quartile ranking, and even within the first quartile ranking, many of the funds are in or just shy of the top 10. So really thrilled with performance. Since the market low, we're also in the predominantly in the first quartile. That's the 23rd of March. So that's when markets really rebounded from the sell-off we saw earlier in the year. Expanding throughout the proposition, I always include some slides on the MPS, which is less actively traded, but nonetheless gives exposure to the key themes we as an investment team continue to like. This performance is from inception, so from the end of April, and it's you know, more or less the same story. Very strong performance, predominantly against the IA sector peer group comparison. So very happy with how we're progressing so far. I haven't got a slide specifically on the protection portfolios, but one thing I did want to highlight is that the thing that we really needed to see was a pickup in market returns, because if markets are positive, it means the underlying assets in the protection portfolios have a chance to gain in value. And when that happens, it helps increase the delta of the fund and the exposure to the market, and it can have a self-fulfilling effect. Well, it's very positive, I think, that the last month, the month of November, for the capital protection portfolio, saw the most positive and the largest returns on a monthly basis since December. So we are starting to see signs of life, and if that continues, then we could really potentially see a more meaningful pickup in the protection portfolios. It was slightly more muted in the capital and the ESG protection portfolios, but in the income protection portfolio that has a higher exposure to the asset portfolio and a higher delta, the returns were very positive, just shy of 2% in the month of November. So yeah, admittedly it's below the unprotected funds, of course it is, but nonetheless signs of life. So I wanted to explicitly mention that during the performance slides. Moving on to the markets. This is this slide many of you will be familiar with. It was included in a number of blogs I wrote, and I've included it in prior market update calls. The key point of this slide was that historically, when stock market valuations in white have exceeded the size of the global economy in red, it has been a period that precedes a subsequent sell-off in markets. And you can see that via the yellow circles. You can see the white line crossing the red line and then falling down again. And this is the kind of valuation indicator that many asset managers and commentators and strategists use to determine whether or not the market is overvalued or not. So what's really interesting is the huge turbocharge right there on the right-hand side of the chart, shooting through the top of the yellow circle. We are now completely and utterly detached from underlying fundamentals. We've never seen anything like it. It's truly and utterly historic. We know the reason for it, and that's effectively the amount of liquidity that has been printed digitally and physically and pumped into the market, and that liquidity needs to go somewhere. And the first place it finds a home is in financial assets. Eventually, that trickles through into the real economy, which is why next year and the year after, if the global economy continues, and we believe it will, then you could actually see markets getting ahead of themselves and perhaps falling. But the first home is a financial within financial assets. More specifically, that turbocharge off the right-hand side of the page is explicitly linked to not only the breakthrough in terms of the vaccine with Pfizer-BioNTech, closely followed by Moderna and Oxford University AstraZeneca, with obscene efficacy rates in phase 3 trials, and the UK has formally approved the use of drugs for widespread use for the first vaccine, and in a couple of days we're expecting the US to follow suit, and this should allow a gradual reopening of the economy into 2021. Markets price these things in advance. It's getting priced in now. So effectively, it's catalyzing this resurgence in expectations for demand in the economy against an ongoing backdrop of lower for longer interest rates. Central banks are in no hurry to tighten financial conditions because the underlying economic recovery is still very fragile. Massive liquidity injections, and of course the fiscal stimulus packages that we've seen. And also during the month of November, that narrative went into overdrive because not only did Donald Trump finally say, all right, I'm not going to say I lost, but you can start the process for transferring power to President-elect Biden. A lot of people were worried that Trump was going to truly throw his toys out of the pram, and it seems like that narrative has now come to an end. But more so, we also had Janet Yellen being nominated as US Treasury Secretary. She's a known quantity, which reduces a lot of uncertainty. But more than that, she was all about spend, borrow. Well, now in her new role, she can eat the dinner she's been preparing as head of the Fed for many years. And we're likely to see much closer coordination in fiscal and monetary policy that's likely to continue this narrative as we go forward. But the key driver behind that recent pop is this slide here. License to print money. This chart shows the monetary base in white. Think of that as the effects of quantitative easing. The M1 money supply, which is a relatively broad definition of the supply of money within the economy. M2, which is another definition of money in the economy, and then possibly the narrowest definition on here, currency in circulation, so notes and coins, etc., in yellow. But if you focus perhaps on the blue line, which I think tells the story best, it's gone vertical in the month of November, which is remarkable because if you think about it, the early stages, you can see the first surge in the blue line early on, and it started to taper off a little bit as we've had the vaccine and signs of the economy coming to life. What is behind this huge surge in the money supply? What is it going on behind the scenes to justify that? Well, I don't know what the answer is, but I do know it's gone into absolute overdrive, and that is what is really pushing these markets to ever extreme highs as we move on. Now, if you put all of this in the hopper and you mix it up and you ask for an answer to the question, where does the S&P 500 end up next year? Goldman Sachs would say 4,300 on the index. Now, that's the most punchy estimate out there. There are many other commentators, for instance, Citi, for whom the price target is we are already 12% over their target, but they've decided to hold on to it for now, telling you that not many strategists out there know what's going to happen. There's a lot of uncertainty. There's a wide range of forecasts, and that just reiterates what I was saying about truly being in historic territory. There's no real historic precedent for this. But if you do buy into the narrative that what is driving markets and will continue to drive markets is liquidity, and I think that's true. Gravity will eventually assert itself, but for now, liquidity is driving the markets. Then the price target of 4,300 isn't completely crazy. It's simply a move back to the middle of this long-term trend we've had in place since 1950. And just as a very brief reminder, that red circle highlights the market low on the 23rd of March for the S&P 500, which, if you're looking at this chart and you're using it for market timing, what a great long-term buying opportunity. And actually, that's exactly what we did in the Acumen portfolios. We, having already raised cash earlier in March, we took the opportunity to re-engage and invest in equities around the market bottom, and part of that is the reason why we are in the first quartile predominantly relative to our peer group over that period. So I want you to keep in mind this chart and the liquidity story and the positivity behind it as we go through the next few slides, which is to inject is to kind of be honest with you, open, spark a debate, and engage on the negative side of the equation. What are the key risks to that 4,300 target? Well, Gordon Gekko said greed is good. I don't know whether it's good or not, but it's certainly back. And this chart kind of shows that. Now, a lot of individual stocks or certain indices are going vertical. One such example is Tesla, which is getting forced into the S&P, forced indexing by the end of the year, the 18th. We're going to see huge sums of money invested in one go, and that's led to this preemptive rally in the value of Tesla, which is up approximately tenfold in 2020 alone. Those returns look borderline parabolic. And to put the Tesla returns in contrast, I've also put on Bitcoin, which is also up an astonishing amount. So since the start of 2019, Bitcoin is just shy of up 300%. I put on the NASDAQ because we commonly refer to the FANG stocks as kind of leading the charge. That's in yellow. And then the S&P 500 is all the way down there last in white. It really gives you a sense of how some markets are priced to an absolute extreme. Speaking of extremes, investor sentiment is at an extreme. This the white line here is called it's the American Association of Individual Investors. It's a survey that's carried out on a regular basis to kind of gauge investor sentiment. And here I've put on the spread between bulls and bears. If you're a bull, you think the market's going to go up. If you're a bear, you think it's going to go down. This index is one minus the other. And as you can see on the right-hand side, the white line is poking up above that dashed yellow line that I kind of put on there really just as a gauge to show you that we are at absolute extreme levels. Now, if you move your eyes to the left, the last time we peaked above that dotted yellow line at the end of 2019 preceded the large sell-off in the S&P 500 in blue above. If you move your eyes a little bit further to the left, you can see early 2019, and if you glance up, a similar kind of price action on the S&P 500. Move your eyes further to the left to the larger spike that we saw at the beginning of 2018. That was when inflation expectations started to spike on growing wages, and investors started to price in the growing likelihood of an increase in interest rates, which sounds absolutely crazy when you think about where we are today. And that also coincided with an extreme in investor sentiment, and once again, if you cast your eye up, another sell-off in the blue line. So effectively, extreme bullish positioning amongst individual investors. Now, we don't just have to refer to this American Association of Individual Investors. If you look at Citi's Panic Euphoria Index, it's also through the roof. If you look at CNN's Fear Greed Index, it's also through the roof. And if you refer to the Bank of America Global Fund Manager Report, which is a monthly report that comes out to give investors or readers an idea of how investors are positioned and what general sentiment is out there, it's the most bullish of 2020. It's currently pricing in a 20-year high in GDP expectations, and it has the lowest fund manager cash levels since before the crisis. Not far off a contrarian indicator that's usually triggered from this report, which suggests maybe perhaps thinking about selling. And that kind of leads me into this kind of alternative narrative. If we're already ahead of ourselves, then many investors who have already bought the rumor may well sell the fact, which is the vaccine. Let's keep moving on through the slide pack. Investor complacency. So not only are we seeing a massive value disconnect between asset prices and the economy, not only are we seeing a huge asset price inflation amongst particular asset classes, not only are we experiencing extreme high forward multiples and price to sales ratios, this belief that prices will continue to go higher, aka a fear of missing out, which is what we saw on the prior slide. There's also very little desire for downside protection, aka investor complacency. Now, this chart here is a ratio of puts to calls. If you buy a put, then you're buying protection from markets falling. If you buy a call, then you're leveraging your upside to further gains because you only got to put a deposit down on the premium of the call option. I wouldn't worry too much about the dynamics of calls versus puts, but what this is effectively showing is if you go back all the way back to 2000, the put-call ratio has fallen below that yellow line, which means, historically, we're at a low point in terms of investors looking for protection relative to those looking to engage in the market. So, it looks like everything's pointing more or less in the same direction. And when everything's pointing in the same direction and everyone's thinking the same thing, then that can be a cause for concern. So where does that leave us? Well, it leaves us in an awkward scenario where it kind of tells us what we already know. Valuations are very, very detached from fundamentals. The disparity has never been more extreme historically. We're truly in untested territory. Given the way markets are positioned, we need to be cautious and we need to be mindful of the fact that we could be approaching extreme bubble territory or bubble territory. But on the flip side of the coin, when is that going to come? We have to be respectful of momentum. If you were to just sell down your assets and go into cash, you were going to lose out. You would have lost out considerably versus the market composite benchmark. Momentum is clearly in one direction, and the thing that's driving markets is liquidity. I don't think liquidity is going to go anywhere anytime soon. I think it's here to stay, mainly because central banks and governments are terrified of popping the bubble, and therefore they have to keep the show on the road. The US is still struggling to get the stimulus package through. because Mitch McConnell is holding things up. But come the new year, that may well change as we get a change. As we get a change, we've now got Janet Yellen coming into the U.S. Treasury, as I mentioned before, which I think is good for markets. You know, that narrative could last for quite some time. So even if you acknowledge that we are in a bubble, you know, bubbles can last for a long time, and it's only after the fact that you can see when the bubble bursts. And December, of course, is also a period where you get seasonality. I think before I move on to these next few slides, and before I hand over to Andrew and Circa, kind of want to just finish off on something, which is, you know, what can we refer to in terms of a playbook? Well, you know, investors that are sitting on huge profits usually only really take profit based on some kind of tax event. And that's what you see historically as you enter a new tax year or a new year. So markets will continue to rally all the way through December, perhaps. But as we come into the new year, tax considerations may come to the fore. That's something, I think that's something to be mindful of. Now, one of the things we've also been talking about is this great rotation in markets. So if you think we're at the beginning of a new cycle, a new economic cycle, if you're of the opinion that liquidity is going to stay here and markets can move higher, and in the short term, I think that continues to be relatively likely, then what is going to keep this going? What's going to keep the show on the road? That's the question that matters. Now, one of the things to keep the show on the road is the US dollar. A weak US dollar means loose financial conditions. It makes life easier for large multinational corporations. It makes life easier for emerging markets, and it helps improve investor sentiment. So this is a chart that many of you are familiar with. We first called a potential weaker US dollar all the way back in April, when we broke out of that channel there in yellow. And then we fell to this kind of decade-long support line in white, and it was kind of a bolshy call, really. We kind of said, this time it's different. And if anyone says to you, this time it's different, you shouldn't believe them. But we said it, and we were right, and we broke through it. So very happy with that as an investment call. And then we also highlighted, last time we did this call, that we were at a key level for the US dollar. And on the right-hand side, you can see a little zoomed-in version of when we were at that level. And what you can see is we've now broken through that relatively decisively. So that's one sign that maybe the show can go on. Now, just to bring this back slightly about one direction bets, this chart's interesting because this shows dollar positioning versus the dollar index. Dollar index is in white, so same as the last slide, and dollar positioning, which is negative, a lot of people are short the dollar, is in blue. It's at an extreme level. So for further dollar weakness, we need to see that trend continue and not reverse. And the risk of it reversing is greater the more overextended positioning is. But nonetheless, we are continuing to see a weakening dollar, and that remains one of our key calls for next year. Reflation is another key theme. We don't have a slide for it, but we are actually seeing a pickup in inflation expectations that has now risen all the way back up to a 1.5-year high. That's good because actually we've been seeing that trend going into reverse a little while ago, but that's back on, so that's positive news. Sorry, if you just go back a few slides, Connor. That one, this one, yeah, perfect. And the other theme is long bonds, by which I mean 20-year plus US Treasury bonds. You know, are we going to see the curve steepening? If we see the curve steepening, then you're going to see these long bonds underperforming. Underperformance is where it goes down on this chart, and we've seen it fall back below that yellow line. And if you cast your eye to the left-hand side, this is a trend that's been in place. The price action has been between these yellow lines for an incredibly long time. So if we're falling back below it, it's a very strong indicator that maybe this theme, this rotation theme, is going to continue for a while. So on that, I think now's a good time for me to stop talking and me to hand over to Andrew, who can give you an update on this from a fixed income perspective. Andrew?
Thanks, John. So yeah, if we just go back one slide, Connor, just quickly. So yeah, as John mentioned, breaking below that line is a significant indicator to us as a team, as an investment team, that this rotation is happening within markets, and longer dated, safer assets are looking to underperform going forward. So Connor, if you move on to the next slide now. So this is one position we've actually taken, that we've actually implemented in the portfolios. So as you can see, this is the option adjusted spread is the white line. So that's the premium you get for taking the risk in high yield bonds. And then the blue line is small caps in the US. So it's the Russell 2000. As you can see, back at the beginning of November, there was a large divergence between these, and these have been very highly correlated over the last, I mean, this is a 2-year chart, but much longer, it's still correlated. So what we did about 2 weeks ago, we increased our exposure where you can see that yellow line, the yellow arrow, because we think there's going to be a catch up in the white line to the blue line, which will mean the portfolios go on to outperform, provided that happens. And because of our view that the safe haven assets from the previous chart are looking to underperform, this is a riskier position, and we think that's going to now outperform in the going forward. And then if you move to the next slide, Connor, staying on the topic of corporate bonds. So one thing that we did in the portfolios back in March was we went overweight investment grade bonds in the US, and they've done very well since then, being one of the top performers in the portfolio. But the yield on those, because they've done so well, lots of investors have put their assets into them and pushed down the yield that you actually get for them, to the point that the white line, which is the yield on US corporate bonds, is now lower than the blue line, which is US inflation expectations going forward. So basically, investors aren't receiving, in real terms, any return for their investments over the in yield form rather than capital gains over the next 5 years. So one thing we're thinking within the portfolio is that we're going to reduce our duration risk by going underweight the full investment grade portfolio and looking to take our exposure in shorter duration assets, so that when historically you can see where the blue line has been higher than the white line, yields have then risen, which has caused a sell-off in corporate bonds. And that's why we're looking at shorter duration corporate bonds, and also the previous chart, which is high yield bonds. I think I will pass over to Circa, I believe, after this.
Sorry, I can't hear Circa there, John, so I'm not sure. Would you like to go through these slides? And we'll try and get Circa in at the end if he wants to speak, but I can't see him on, I'm afraid.
Okay, yeah, he's sometimes we have data connectivity issues because doing up the roads and stuff. But all right, well, when he's back on, just interrupt so we can give Circa a chance to speak. But I'll continue in the meantime. So UK equities is one way of playing this rotation theme that we've been talking about. UK equities are very exposed to more value cyclical parts of the economy. There's a large number of companies on there generate their revenue from international exposure. Think commodities. The exposure to tech, for instance, is tiny within UK indices relative to US, like the S&P 500, where the FANG stocks make up the majority. So if something's going to do well, if we get this rotation, UK equities is on the list, number one. Number two, UK equities are extremely cheap. They have done almost nothing but underperform a basket of other equities, and that's what this chart shows, which is the FTSE 100 relative to other global equities, excluding the UK, and it's fallen right out the bottom. So, and then of course the other thing that's been holding back UK equities over this period, particularly more recently, is uncertainty over Brexit. Now, your guess is as good as mine as to whether or not we actually end up with a deal on Brexit. It seems like it's coming down to the wire. I think we are still of the opinion that we will get some kind of skinny deal. It's likely to be agreed 30 minutes before the ever-shifting deadline, which is a little bit, well, it invokes a little bit of anxiety. But nonetheless, the removal of that uncertainty could well also be positive for UK equities, particularly for institutional investors putting money into the space, ideally with a deal, but nonetheless, the removal of uncertainty in a no-deal scenario regardless. Now, one other thing that's worth mentioning is historically there has been a negative correlation between sterling dollar and the performance of UK equities. But that doesn't mean there's always a negative correlation. And in actual fact, over the last few months, we've seen a positive correlation. So if we do get a Brexit deal over the line, it's likely that we would see not only a bit of a jump in sterling dollar, which could go as high as 140 or just shy of that if we do get a positive outcome, and could continue to climb higher to its longer term moving average by the end of 2021. But that doesn't discount the possibility of UK equities also performing very well over that period. And in actual fact, from our perspective, we've put UK equities to an overweight outlook in terms of how we perceive them as part of this broader rotation. Is Circa back on the line now?
Yeah, can you hear me now?
Yeah.
Oh, perfect. Sorry about that. And yeah, I can talk through this next slide. So this is a really interesting chart that John put together. This is kind of showing how we've been looking at the rotation between value and growth, and this is taking a look at that in the emerging market space. So we have the white line, which is showing the emerging market Asia index versus the emerging market EM, and then the red line is the MSCI EM ex Asia versus the MSCI EM. You can see over time there's been periods of great divergence between emerging market Asia and emerging Asia. So emerging market Asia kind of consists of countries and companies that tend to have a more of a skew to quality companies and also growth stocks, while those outside of Asia, namely those in Latin America, such as Brazil, also areas like Russia, tend to be a lot more cyclical and value based. So there goes through kind of sharp periods of divergence, and then we see sharp reversals. So one region will outperform the other, then we'll see a sharp divergence. And we're seeing that happen. We've seen that happen quite sharply this year. So those quality regions, such as China, Taiwan, Korea, how we have been positioned since the pandemic, have outperformed massively. However, we think there's scope for this to change. So we've seen a great divergence, and if you just look at the distance between those two lines, we haven't seen a divergence this big since the Asian financial crisis and just after that in the late 90s and early 2000s. So we're looking at that closely, and we think there could be well, we've seen these other regions begin to outperform, and we think there could be more scope for that. So if we move to the next slide. So this is one of the ways we've looked to implement this theme. We've kind of dipped our toes in the waters with it. So we've opened up a position in Russia. Russian equities are heavily cyclical and value based, high exposure to energy and financials. They've come under a lot of pressure this year for a few reasons. Firstly, obviously the nature of the companies in the Russian index. Energy companies come under pressure due to the fall in oil. We've had a number of obviously Russia, the number of COVID cases and deaths there has been very high, and over time you can see that going back to say 2014, there's been when we look at Russia's equity performance versus the emerging market index, it's kind of traded within this kind of long to medium term channel. However, this year it dropped out of that, and it's something we've watched. We've been waiting and watching it closely to see if it can fall back into the channel. And on the back of the vaccine news, as we've seen value and these out of favour countries and companies come back into favour, we've seen it fall back into the channel, and it's tested that support level a few times. So we've initiated a position. If we go all the way back, that would be 55% of outperformance. But yeah, so that's the Russia trade, and we've got our eyes on a number of other areas in the emerging market sphere.